Hey, good morning. A little smaller crowd. Super Bowl, I guess. Make sure you get your name on the sign. I wanted to point out our data office size got another good presentation on Wednesday. This one is taught by a professor in our data analytics group, and it's all about visualization and presentation of complex material. And I think this is really good no matter what area of accounting you go into. I felt like one of the things that I brought to my clients was I was not the smartest person in the room. I didn't have any preconceived notions that I was, but I felt like I was the one who was delivering my firm to the client. And so I felt like one of my jobs was to be a portal for which all the good thoughts could get then presented to a client. So I thought one of the things I did okay in my career, hopefully better than okay, was to take and distill very complicated matters into actionable plans for clients. And that to me is all about visualization. I didn't take it through all the tools that you have now available to you. As you guys see, my favorite medium is PowerPoint. But even within that tool, trying to make something very complicated that appears complicated, but nonetheless understandable and actionable is the way to go with clients. Because one, you don't want to make anything sound too simple, because then they'll give you pressure about paying you like a decent fee. But you also don't want to make it sound too complicated that they cannot do it, that it's just beyond their capabilities or something. Because one of the things you'll find dealing with organizations is it's really easy to say something. It's really hard to do something inside of an organization. To really have meaningful change, if you have a planning idea or something that's going to save them dollars on the tax front, it's easy said, hard to do. So you want to convey the complexity without like covering up things, but you also want to say this can be done, and we're here to help you. So anyway, I think this type of visualization and storytelling is going to be really impactful for that. So well worth your time. Okay, we're going to pick up FTC, and we are going to get into the weeds. Okay, so again, remember what I said about foreign tax credit. It's good in theory. It's difficult in practice for U.S.-based multinationals to deal with, and we're going to get into some of those difficulties in practice. So I left you with, on Wednesday, how do we deal with foreign tax credits from a planning perspective, right? We don't want to just be doing the calculation. A good tax professional is doing that, helping a company be compliant, but then also being on the affirmative, how can we make this calculation better? Remember what I said, I gave you the baseball analogy, there are no home runs. Not one thing you can do and then all of a sudden you can claim all your foreign tax credits. It's a lot of singles and doubles in baseball parlance. You have to do lots of things to get there. Each one of them moves the needle a little bit, but if you do enough of them and you're proactive enough, you can make the calculation materially better for companies. So the first thing we do, remember, pay the least amount of foreign tax. We don't want to pay foreign tax and then try to fight to credit it. So let's get the number down as low as we can and then deal with the problem, right, which is trying to credit it. And so there's some planning strategies here we talked about. Where do I source my debt? Servicing of debt gives rise to interest, which is a tax deductible expense in many jurisdictions. Location of my principal activities, how I set up my supply chain, like where's my profit in my supply chain residing? If I have some influence on that from 2 or 3 jurisdictions and the business can be flexible in that, why not choose the lowest tax jurisdiction that works? Because then I'm going to have less problem crediting foreign taxes than choosing the highest tax jurisdiction. So those are important things. Availing of local tax incentives, that was the example following this slide. Whereas if I get a certain amount of investments in that country, they lowered my tax rate. You can do that not for a lot of the developed countries, but more of the countries that are trying to attract foreign investment. You can try to negotiate those types of things to lower your tax rate. And then the tax treaty. Make sure the treaty is being applied correctly if you have withholding tax on a payment coming to you from a foreign country. Because what you'll find many times is the payor is being very conservative. They don't want to get in trouble, so they might have a higher withholding tax rate than is legally due. So do all of that work to try to reduce your foreign tax. This is the example where the deal with country acts for building that facility lowered the tax rate from 30% to 15%. That's the first step you would try to do. Do all of that around the world. Second area is, remember the multiplicand. It's like net foreign source income times the U.S. tax rate. So what's the multiplicand? It's my net foreign source income, which the first part of that is my gross income. So how do I increase my foreign source income? That would be good because that gets my limitation higher. So I've already dealt with the other part, which is getting my foreign tax credit, my foreign tax payment as low as possible. Now I want to get the limitation as high as possible. I know what the components are, but can I turn the dials on each one of those components to see if I can get them as high as possible? So, converting what might otherwise be classified as U.S. source income to foreign source income drives the FTC limitation higher, allowing more FTC to be credited. The effectiveness of changing the source of income to improve an excess credit position largely depends on differences between the U.S. and foreign source income rules. Okay, so we're just working within the confines of the foreign tax credit limitation. If instead I simply shift taxable income from the United States to a foreign country, I'm doing the opposite of what I was trying to do in the first step, which is pay the least amount of foreign tax, right? So be careful if I'm actually moving activities that is going to move taxable income. What I want to do is play within those sourcing rules. Can I get those to be the most advantageous possible? So remember the one strategy we touched upon. If I have export sales of purchased inventory, right, I'm the U.S. company and my inventory is acquired by purchase, the rule is, you will remember, title passage, right? If I can work with the business people to get all my export sales to have foreign title passage so that the foreign customer buys it outside the United States, they take ownership outside the United States, we get to count that as foreign source income. It's going to boost up that net foreign source income, right? We're going to source that as foreign. And so that to the extent I can get that done in my business, I am driving up the multiplicand, increasing my limitation. Another idea is to license US IP to foreign related parties. So if I have US intellectual property that is being used by my foreign subsidiaries, why not license to them? What do I get when I license something? I get a royalty, right? How do we source royalties? Back place of use. My foreign subsidiaries, they're using it in the foreign country. Now the trick here is I need to get that royalty expense to be sustained as a deduction on that foreign tax return. Because here, if I'm licensing it out, I'm going to get royalty income. That's going to be taxable in the U.S. So I need to have an offset. I need to ensure I can get a deduction for the royalty expense in the foreign country on their tax return. So I'm going to have that in the U.S. But if say their rate is 21%, for instance, and our tax rate for corporations is 21, then I'm neutral from an income tax perspective, but I've helped my foreign tax credit. Deduction at 21, I got inclusion at 21, but now I got foreign source income, my foreign tax credit. Okay, so that's an example. And don't underestimate how difficult that is to get a sustainable tax deduction on a foreign tax return. The foreign jurisdiction will immediately question whether that's a viable deduction. What are you using that royalty for? So you need to build your case why that royalty is driving income that is taxed in that country, viable expense. Those are strategies to boost up the foreign source income. Conversely, I can decrease my foreign source expense apportionment, right? Because that multiplicand is net foreign source income. Drive up those that are considered foreign source, drive down the expenses that are considered foreign source to get the net income up. So that would be things such as manage my interest expense apportionment to the extent possible. Remember, we have specific rules for interest expense. And that's based on assets, and so I could decide where my assets are located, maybe not existing assets, but future assets. The company is deciding, where do I build my next facility? The United States or Mexico? Maybe you could say, well, if we put that CapEx in the United States, that will attract interest expense to US sources and keep it away from foreign sources, boosting up my net foreign source income. If you decide to put that in Mexico, it's going to be a drag on our foreign tax rate. So you might have some influence in that. You might not always win, but you can put forth the tax position view on that thing. Revisiting and optimizing apportionment keys for SG&A. Remember those examples we talked about? Some of them was allocating the apportioning the SG&A expense between U.S. and foreign sources based on gross income, based on margins. Revisit those. Am I using the right allocation key that might give me the best answer from a lower allocation of foreign sources? Okay. Performing a stewardship study to determine whether the proper cost centers are included in the optimal apportionment keys. Stewardship is that headquarters expense in a review capacity. So headquarters have some of that. Usually it's very expensive because it's the C-suite overseeing the global business. Do I open up a project where I look at that bucket of expenses and do some time studies? Do I interview all those people and really talk to them about what is the portion of your time that is focused on U.S. oversight versus non-U.S. oversight? That is my apportionment key to lessen the amount that I send to foreign sources, right? Trying to boost up that net foreign source. So if you think about that, you're dealing with all three of, remember the yellow rectangle I had? It was net foreign source income, so that's income less expenses. I've dealt with the income, I've dealt with the expenses, and then it's times 21%, and then it's the lesser of that limitation are the foreign tax paid. I've already done step one, lowering the foreign tax paid to the extent possible. I'm dealing with all parts of that calculation. I know the rules. I'm going to get my business to be the most matched to the best fashion I can to those rules. Okay, let's do 410. Did somebody sign up for 410? Okay.
So this example shows how changing the way expense portion can increase the foreign credit limitation.
Can I get that sheet of paper? Let's go. Go ahead, sorry.
Okay. US code.
You guys got to see all my notes. That's great.
It was a bit confusing.
Sorry about it. Here, it's coming back around. Okay, now I do this.
Okay. US code pays tax at 21% rate, and they have branching country that pays $1 million in creditable foreign income. So first, when SG&A is a portion based on 60% of total SG&A is allocated to foreign source income. As a result, net foreign source income is reduced to $1.9 million, which limits the foreign tax credit to about $399 at 21% US. So since US actually paid $1 million of foreign taxes, then half of those credits cannot be used and it becomes excess foreign credit. If instead expenses are apportioned based on gross profit, only 50% of SG&A. This increases net foreign sales income to $2 million, which raises the foreign tax credit limitation to $420,000. So the amount of excess foreign tax credit decreases, and US code can use additional to $21,000 of foreign tax credit.
Yeah, so that's not the biggest number, but you could put a lot of zeros to this and see how it could be very powerful. So you're just toggling between two different apportionment keys. Which one allocates the least amount to foreign sources, which you're looking, we're only in the foreign tax credit limitation world here, right? So if I can push some of the expenses towards the US and away from foreign, that's going to increase the amount of foreign tax credits that I can use. Now, I have to be ready to make the case why gross profit is the best apportionment key here, but I can build my facts around that, right? It's colorable, this is why I can do that. But that's just the way this is just a spreadsheet that you're using in the tax department to try to get this. This is not moving the expenses from a global perspective around different tax regimes. Okay, thank you. Okay. Another area where you can mitigate expired or pressure on foreign tax credit position is cross-crediting foreign tax. We've had several questions about this throughout the last couple sessions. And this has to do with averaging tax rates across jurisdictions. Okay, we've had simple examples where I have U.S. with one foreign investment. That's not all that common. Usually somebody who is doing foreign investment has multiple foreign investments. Certainly your mature international companies have lots of foreign investments. So to the extent I can average my foreign tax credits across different jurisdictions, and I put in the bubble here, sometimes this is called averaging, sometimes it's called blending, but the concept is, can I take low taxed income and put it in the same basket as high tax income so that the tax rate is blended down to something in between the two, the high and the low. Maybe something closer to 21. Okay? We call that cross-crediting. In practice, people will call it averaging, they'll call it blending. Politicians will call it either one of those as well when they're talking about this. But this is where we're trying to do that spreading across different countries because each country has their own sovereign tax rate, right? So what this can do is, if instead I had to do by each type of investment, then I could be excess credit in one because it's a higher tax jurisdiction. I could be excess limit in another because it's a lower tax jurisdiction. If I can put them together, that alleviates those two problems. Right? So I can cross-credit, but there are limitations on how much cross-crediting I can do. So let's do 412. Did anyone sign up for 412? Okay, I'll do 412. Okay, so USA Co. has 1 million of country X source income and not any U.S. source income. So we're assuming simple facts, nothing, they break even in the U.S. and they have $1 million of income in country X. U.S. tax rate is 21, country X tax rate is 30. So we're dealing with a high tax country. Okay, so we have 90,000 of excess credits. So we have creditable foreign taxes of 300,000. Remember, when we do how much foreign tax we can credit, it has to be creditable. That's compulsory. It has to be legally due under foreign law, and it has to be an income tax in a U.S. sense, right? We have to reach net income. Okay, so we've done that in this hypothetical, and that is 1 million of income times 30%. That gets us to 300,000. So that's our step one. Step two is to compute the foreign tax credit limitation, and you can either do it the long form way or the shorthand way. I'll do it the shorthand way. That's the net foreign source income times 21%. So that's 300,000. 1 million times 21. So that's 210,000 is my FTC limitation. Right? They're depicting it here based on your pre-credit U.S. tax over foreign income over worldwide income, which is the same result as my shorthand on the right. So then step three, I take the lesser of the limitation or the amount of creditable foreign tax, and the limitation here is lower because I'm dealing with a high tax country. So I've limited to 210,000. That leaves 90,000 of excess credits. Carry back 1 year, forward 10. Right? So what is depicted here in the next slide is what happens if I change the facts and I add operations in country Y to the mix. and I improve my foreign tax credit position. And so here, I have the same operations in country X that I started with. Same issue I had before where I have a 30% jurisdiction and the US is only 21. But now here I put $1 million in country Y, and that's a 12% tax rate. So let's assume the business decided to expand. You worked with them, business people, tax people, legal people, everybody worked together. And we decided that country Y accomplished our business objective, and you were able to influence them and say, all other things being equal, I would prefer country Y because it's a 12% tax rate. How does that filter through the example here? So now I have my creditable foreign taxes $1 million times 30%, same as the prior page. And the new million times 12%, so I got 420,000 creditable foreign tax. That's step one. My limitation now is the $2 million of total foreign source income times my 21% tax rate. That's 420,000. My FTC limitation. My creditable foreign tax is 420. My limitation is 420. I have no excess credits. I'm in nirvana. I'm the tax person. I throw a happy hour for everyone to go to because we've hit it exactly on the mark. Right? It doesn't get any better than that. And so what I've done is I've blended these two tax rates together. $1 million at 30% and $1 million at 12% blends to 21. Okay? In a perfect world. Now that tells me that I get to blend these two operations. And that's what we're going to explore for the next few minutes here. Okay? So, foreign tax rates vary across different types of income. Okay? I can have passive investment type income. Remember our withholding taxes? So if someone in a foreign country is paying a passive investment stream back to the United States, that's likely going to be subject to a withholding tax. Withholding taxes are at a lower rate, typically than business income earned in a foreign country. So I could have different tax rates based on different types of income. And so the U.S. tax law allows for distinct, separate FTC limitations. Everyone calls these baskets. Okay, so that's not a code that not a term you're going to find in the tax code, but practitioners call them baskets, foreign tax credit baskets. When you're out there and people are saying, "Well, I got excess limit in this basket, I got excess credit in that basket," they're saying they're doing 4 different FTC limitations. Right now, the United States has 4 baskets. We take all of our foreign income and we place them in one of those 4 baskets, and we do an FTC limitation in each one of those baskets. Okay? So, the thinking behind the basketing is that there's different types of income that are subject to different rates of foreign tax. Not exactly what tax rate, but they're just, some are less heavily taxed than others. What the U.S. is trying to do, right, is the U.S. taxes on worldwide income. To the extent we have low tax foreign source income, the U.S. wants to make sure you pay 21% on that. They want to collect the difference between the foreign tax to get you up to 21. That's the residual incremental U.S. tax. So they want to kind of put that in its own basket, that lower tax type of income, and keep it away from the higher tax type of income, so that they have the right to collect that residual tax on that type. That's the rationale behind the basketing. Okay? Okay. So I want to walk you through this because, and you don't even know that, memorize this. This is just background for you. This stuff always changes. The U.S. always messes around with what are the appropriate baskets. Okay. So you see how old this stuff starts? 1918. The income tax was, I believe, 1970. So right off the bat, when we implemented, I think it's Amendment 16 to the U.S. Constitution that gave the right of the federal government to collect income tax, we started in with foreign tax credits because we had people that were doing stuff internationally. And so we started in with these baskets right there. So we started, but we didn't have any limitations. Had an income tax before we did that. And then so look from 1932 to 1975. we had many different baskets and they were by country. We looked at what you were doing in each country, and you might have 50 different baskets if you were in 50 different countries. Okay? And there's some people, policymakers, who think that's the appropriate basketing mechanic to use. We should look at what you're doing in each country. And that protects us because Mexico might be 30% country, China might be a 20% country, and if I keep them segregated, then I know what's high and low tax. Okay? So for decades, we did by country limitations. I'm going to point to 2003 to 2006. Heyday when I was practicing in this area, we had 8 separate limitations. 8 baskets of income. So we had to take the world's income and put it in 8 different baskets. George, you had a question?
What do you mean by default basket?
So by basket, just think of baskets. When we do the FTC limitation, we do it for that basket of income. Okay, so we're gonna source our income, put it into the baskets, and then we're gonna apportion our expenses across those baskets. So we've been talking so far about one foreign tax credit calculation, but that's the assumption that everything's in that basket. But in this example, the only way I could cross credit is those have to be in the same basket. Because within a basket, I can cross credit. I can't cross credit between baskets, only within baskets. Okay? So just think of it as an FTC limitation for each basket. And the U.S. is trying to guard against blending high tax and low tax operations.
So by basket, is it type of income or country of?
Type of income. At different points in time, you'll see proposals to go back to a by country limitation. And sometimes that gets some momentum, sometimes not. But what this chart is trying to show you is the delineation of the baskets has changed over time and will no doubt change in the future. This is one of those things like if you're in taxation of business entities where we dealt with depreciation and how the government's always messing with depreciation, they will always mess it with these baskets. Every time there's a tax bill, they open this stuff up.
Does it protect against blending the high and low, even though it doesn't restrict? It's not based on the country, so you could technically go with one high tax country and then one low tax. But since it's hard to actually pull that off, that's why it's protecting it. Versus combining 2 types of income, a higher tax form of income, versus the other, that's easier to manipulate than having actually operations
so
in 2 countries.
You'll see this when we get to what the baskets actually are. But for instance, this example, since both of these are effectively branch operations, there's no box on country X operations and country Y operations. They're actually extensions of USACO doing business in these countries as branches. Remember when we talked about business entities in the first week? So I do have one of my baskets is foreign branch operations. It's not by country, it's just by foreign branches. So these 2 would get put in the same basket, even though one is 30% and one is 12%. It's the same type of activity. You're doing business in foreign branch form. I could do 50 branches in 50 different countries, and I would put those in one FTC limitation. And there could be 50 different tax rates. That's all fine, because the U.S. says that is the right way to think about foreign branch activities, and we'll give you one blended average FTC limitation calculation. So that theory of the U.S. trying to smoke out what is low taxed, that's one of the rationales, but it's also trying to look at what are the like kind operations. Okay, and so 2007 to 2017, we had 2 baskets. Very simple. We had one's you'll find one, as we were just talking about, is foreign branch operations, but we've always had a general basket, which is the catch-all. It doesn't fall in any of the others. So for 10 years, we had a general basket, which was everything else, and then one other basket. That was it. So post 2017, this is Trump 1.0, right? Started in 2017. We had 4 separate limitation baskets. That's what we have now. It's 4, still 4. Okay? These are those 4. So for 2025, we have the passive basket, the foreign branch basket, which was that prior example. We have what is called the global intangible low taxed income, the GILTI basket. Next chapter, we're going to spend a lot of time on the GILTI regime. You'll understand what that income is, but that income is going to be its own FTC limitation. And then we have the catch-all, general basket. So what you do is you look at each one of your foreign income streams, you place it in the passive basket, the branch basket, the GILTI basket. If it's not in any of those, it falls to number 4, it's the general basket. And the end result of that is, within each basket, you can cross-credit all your foreign source income in there, regardless of its country of origin, to arrive at a single FTC limitation for that basket. Okay, so we do allow some cross-crediting, but it's not across all my operations within 4 buckets, baskets. Okay? Okay, so we're going to go through each one of those and what those are. The passive basket generally includes dividends, interest, royalties, rents, net gains from dispositions of property that give rise to those types of incomes, and net gains from commodity and foreign currency transactions. So this is really investment activities, right? I'm more passive in nature as the investor. If I'm getting a dividend or I'm getting interest, that's not the same as doing a branch operation or doing a foreign subsidiary where I'm a manufacturer or I'm a seller or something. Right? I'm not doing business activities. The thought being is that this type of income is likely going to be subject to withholding taxes and probably at a lower rate of tax than my other operations. Some types of nominally passive income received by a U.S. taxpayer are nonetheless excluded from the passive basket. What if my passive income is highly taxed, which is measured as greater than the U.S. tax rate of 21? You see this in some African countries. There's some high withholding tax rates that come from Africa to the United States. The U.S. says, okay, that's passive income, but it's not like what I normally see of passive income because I usually see lower tax rates, lower withholding rates on that type of income. So if it's higher tax, I want to kick it out. I want to exclude it from this basket. What does that do? This is a residual, right? If it doesn't hit that basket, doesn't hit number 2, doesn't hit number 3, then it's going to fall to the general basket, and it's going to be there with some other higher tax. Okay. Passive income received from a CFC. We're going to spend a lot of time talking about what is a CFC. That stands for Controlled Foreign Corporation. Nearly every country in the world has what we call Controlled Foreign Corporation rules, CFC rules. Those are the subsidiaries of the parent company outside the country of the home country that you control. Control is usually 50% ownership. Many times you see in a multinational it's 100%. You want 100% of the subsidiary. But what it's saying is that if you get some income streams that are paid by your CFC to your U.S. parent company in the form of dividends, interest, royalties, rents, then we won't put those in the passive basket just because in name only they're passive. What we'll do instead is look at what is the income from which the CFC created the ability to pay that amount to you. So, an example, if my CFC is an operating business and I happen to have lent it money to do its operations and it pays me interest, you might say, well, I remember interest is in the passive basket. But since it was paid by a CFC to me, then what I do is I look through that payment, that nominal form of the payment, and I look to what type of income did the CFC create to to be able to pay that interest to me. If they were a manufacturing company, a sales company, or just business activity, then that would not be passive income. It would be excluded. It's just an exception when I control the subsidiary and it makes a nominal passive payment to me. I look through that payment and treat it based on what's the underlying income of that subsidiary. And then active rents and royalties. You'll see up here at the top, rents and royalties is on its face passive. But what if I'm active to that? Meaning that I could be in the rental business, right? There's two ways to derive rent. I can be very passive. I just let you rent the property. Or I could be active in that rental business, right? Meaning that I maintain the property, I vet who is the user of the property, I do all of that activity around that. Think of your landlords if you're renting. Sometimes you have a very passive landlord, sometimes you have a landlord that's not passive enough, right? So you can be active relative to that. Same things in the royalty business. I can be a very active licensor of my intellectual property, or I can be very passive. If I'm considered active, then I would take that out of my passive basket. So we're really looking at passive income streams coming into the United States. So the look-through rules, I mentioned a lot of this. So these are income from a CFC that on their face would look in accordance, look like a passive income stream. Instead, I look through the character of the CFC's underlying earnings. Okay? If the underlying earnings were not passive in nature, that there was an active business, then this is not active income to me. What this does is it better equates the FTC limitations of operating abroad via a foreign subsidiary, that CFC is a controlled foreign corporation, with if I had operated in branch form, which would have been a direct inclusion to me. Remember back in Chapter 4, we started that first part of the semester. If I do business in branch form, those streams are automatically taxed in the United States currently. If I have a subsidiary, they are not automatically taxed to me. So this is trying to equate the two. So I'm indifferent from a FTC. Okay, let's do a look through rule examples. 416 is shoot.
U.S. individual has owned 100% of foreign corporations.
So let me pause you there. So I said it's a controlled foreign corporation. So it has to be a foreign, has to be a corporation, I have to have control. They own 100% of that. We'll go through in the next chapter the nuances of determining whether something's a CFC or not, but that's critical to this rule applying, is that entity has to be a CFC. But 100% ownership is going to get there by you. Okay, go ahead.
Foreco has earning and profit of 1 million, which of 800,000 is general limitation income and 200,000 is passive limitation income.
So that general limitation income, just think of that as operating income. So it's either manufacturing or it's doing sales activity, but there's a business element to that. So what it's saying is 80% of that $1 million of earnings is created by its operations, and 20% is due to passive income streams that's coming into that CFC. Okay? Okay.
Foreco pays 100,000 dividends to the U.S. individual. Pursuant they abstain to rule for dividends because 80,000 of Foreco's earnings and profits is general limitation income and 20% is passive limitation income. The U.S. individual allocates 80,000 of dividends to general limitation income and 20,000 to passive limitation.
So we're trying to we have to do our FTC limitations. We're trying to put this $100,000 dividend that we receive in one of the 4 baskets. If I just stopped at looking at the income stream and said, oh, it's a dividend, it goes in the passive basket, then I wouldn't be fully applying the rules. And so since this is a CFC, then I look through the name of the amount of the name of the income stream coming into me. I look to the underlying earnings that give rise to the ability to make that payment, and I source the $100,000 payment as 80% of that is general limitation, the 4th bucket, and 20% stays in the 1st bucket. Okay? That's the effect of the look-through rule. I look through it to the underlying earnings that give rise to the ability to make the payment. I source accordingly. Okay? Great, thank you. Okay, foreign branch basket, that's that example we went through a few minutes ago. It's comprised of income by direct operations in a foreign country. So I'm doing business directly. I don't have a foreign subsidiary, foreign corporation that's involved. And it has to constitute a separate and clearly identified business unit that maintains separate books and records. Technically, that's called a qualified business unit. But that's when, at what point does my branch operation become a business? That's effectively what you're asking. Is it the first time I send an employee into that country? Unlikely. What if that employee goes 5th time into that country and stays for 2 months? Starts meeting customers, starts executing contracts, starts developing a business. At one point in that timeline, it becomes a business, right? And so that's what you're looking for. It's a branch operation, so you're just entering into a new country in your name. At what point does it become a business? If it does, then it's a branch basket. You are doing operations in a foreign country in the branch. It was created in 2017, and it took income that was previously included in the general basket. So we created number 2 in that list of 4. It effectively pulled it out of the 4th one because the U.S. wanted to at that point in time. And it prevented some cross-credit, to guard against the cross-crediting of some low-tax general basket income by applying look-through rules to a dividend from a low-tax subsidiary. So the government was trying to, again, hone in on what is low-tax and what is not. So they wanted to try to do that via, let's create a basket that's all of my foreign branch operations. Treat them all and blend and cross-credit across those. Okay, here's another example of that. So 414 is second. Yes, George.
Yeah, my question is in regards to the previous
So if the example was I owned 80% instead of 100, when we get to defining what is a controlled foreign corporation, it would still be a controlled foreign corporation. And what you would do is, if you still, as the 80% owner, there was an 80% and there was someone else over here that was a 20% owner, then if I got a $100,000 dividend from them, I would still look through to the underlying earnings to distinguish between what portion of that 100,000 is in what basket. So the key dividing line is 50%. It's controlled. So whoever, think of, if you're having a vote, who gets to control? It's the majority owner. So if you're greater than 50%, then you're a controlled corporation. And there's some nuances to that we'll explore in the next chapter. So this is deciding what is a foreign branch and what is not. This is what the nuance is.
So the U.S. corporation's activity in country F is a qualified business unit for U.S. federal income tax purposes. This corporation operated only a warehouse in country F. Its activity expanded to include a sales office, marketing staff, and a repair group. These activities represent a separate and clearly identifiable unit of a trade or business conducted outside of the United States. In addition, the U.S. corporation maintains separate books and records for its country F operations. So, satisfying the formal requirements for UBQ status. As the country F operations are conducted through a foreign branch rather than a separate legal entity, the income and expense of the QBU are treated as earned directly by U.S. corporation. So the income generated by the country F QBU is classified as foreign branch income, and any foreign income tax paid with respect to that income are subject to the foreign branch income limitation under the foreign tax credit.
And so, factually, what is this operation in country F? They start telling you, well, there's a sales office, there's a warehouse, there's marketing staff, repair group. You're pretty comfortable. Well, that's a business, right? There's actual people there. It's not like very temporary or very transitory touches. It's actual real things going on there. That would give rise to a certain level of business that would constitute this being a branch, meaning that those results are then placed in the branch basket. Okay, thank you. Okay, my third basket. This is the guilty basket. So this is where, when we get into the next chapter, where you're going to have to be a little nimble, because when I was telling you, if you go to work for an organization or intern for an organization in the tax department, they may be doing the guilty calculation in the coming months for 2025. That was changed when the One Big Beautiful Bill Act changed it for prospective in 26. So I'm going to be doing a 25 and then a 26 for you as we talk about guilty. So, but for those tax returns that are being done now and in future months for 25, we have the guilty basket. And so the details we're going to cover in chapter 5, but this is guilty basket includes income of a CFC in excess of a 10% return on its assets. So what we're looking at here is when a U.S. company owns a CFC, there's no payment from the CFC to the U.S. parent. Remember when we talked about business entities in the first part of this semester, we don't tax, the general rule is we don't tax the CFC directly. These regimes, which we're going to cover in chapter 5, the anti-deferral regimes, would then pick up a portion of the CFC's income and immediately tax it in the U.S., irrespective of there not being a distribution. This is the worldwide taxation system that the U.S. has. So we tax the CFC's earnings, some of its earnings, immediately in the United States. What earnings? What is called the guilty, intangible, low-taxed income. That is a very formulaic-driven calculation that we're going to go through in chapter 5. Basically, you're going to look at a return greater than 10% of its tangible assets. That's a rough proxy. What is intangible assets? It's global because we're looking at worldwide, and we want it to be low-taxed. So that's going to put us into the guilty basket. Whatever that is, that's our third basket. So if I have a bunch of subsidiaries of my U.S. parent company, I'm going to be going through and doing guilty calculations on that. Okay. I do that for 25. It got tweaked as to how I do that in 26. It's similar in nature, but got tweaked in the beginning of 26. Okay. My last basket is what I call the general basket. That's my catch-all. Any foreign income streams that didn't fall in the passive basket, didn't fall in the branch basket, didn't fall in the guilty basket, it all falls to the general basket. It's commingled in the general basket for an FTC limitation. Okay, so this can include foreign source income derived from the sale of purchase inventory with foreign title passage. Remember, if I have a U.S. parent who's exporting, and the inventory I export, I purchased, source title passage. That's foreign. That's not passive basket. That's not branch basket. That's not guilty. That falls to the general basket. That's an example of what might fall down to this level. Okay. Nominal passive income received by a CFC stemming from underlying general basket earnings, which is excluded, right? Remember, I look through the passive stream paid back to the U.S. If that foreign subsidiary is generating general basket income, and that's gonna stay general basket income paid to the United States. And then financial services income. Financial services income is for the financial services industry, fascinating history. But a financial services company is dealing with passive flows, right, by definition. There's lots of dividends, interest, and all those types of things going on in its income statement. They argued that it shouldn't be financial services income. It is my general basket income. It is my operations, even though they're nominally passive income flows. But that's my business. Yes, Arthur.
So because excess foreign tax credits in the guilty basket, they can be carried forward.
Yeah.
How do multinational companies manage high tax CFCs so that they don't end up with a lot of permanently unusable tax credits?
Great question. Okay. So we're in the third basket. I operate around the world in foreign subsidiary forms. That's just the way I do my business. If I'm in Germany, if I'm in France, if I'm in Italy, and I'm paying high rates of tax, then I'm going to have pressure for that FTC limitation, like you're saying, in that basket, the guilty basket. And then the question I would have is, we know we can go back 1, forward 10, but if it's a problem in all those years, it's a problem, right? And so this was a big issue for U.S. multinationals. They were saying, and you'll see this when we get to the guilty calculations, I am suffering double taxation because I can't claim a full foreign tax credit. That's the end result. So in the One Big Beautiful Bill Act, and what changed, what I just said, guilty regime for 2017 to 2025. Now we have a slightly different regime going forward from January 1 of 26. You'll see it's slightly different, but it has alleviated some of that problems. So remember when I said I allocate interest expense? We have specific rules. We allocate that based on assets. So many times, the interest expense allocation was causing excess credits in the guilty basket. The One Big Beautiful Bill Act said no more interest expense is required to be allocated to the guilty basket. And that is going to help a lot of multinationals be able to create more foreign source income to utilize those credits. But I think you're starting to put the pieces together. This is exactly what companies confront. And when the rules frustrate them and cause problems, permanent problems, like a permanent excess credit, then they will tell their politicians that and try to lobby for changes in the rules. And so they found that One Big Beautiful Bill Act, which came about because we had individual income tax things that they had to deal with. So the document was open. They were going to pass legislation. That's when business rushes in and says, you got to do this, you got to do this and this. And that's one of the things they changed. So you'll see, we'll talk a lot more about that next year. Okay, let's do this. This is going to show you how the different baskets operate. Okay? So 415 is meta.
So in this example, the US Co earns 3 different streams of foreign income. The first is interest from a UK bank that's exempt from withholding. And then the second is operating.
So let me put you there. So it's exempt from withholding. So I got interest paid from a UK bank on a deposit that the US Co has in the UK bank. And it's exempt from withholding, meaning that when you read the US-UK income tax treaty, it says interest between our countries is assessed a withholding tax of 0%. That's why it's exempt.
And then the second source is operating income from a Canadian sales office. And then the third source is interest from an African bank that incurs a withholding at a 25%. So if we look at the first stream from the UK bank, that would be passive. That would fall into the passive basket because of that passive income and the exempt from withholding tax.
Yeah, it's passive because it's interest. It's not. The only exception we talked about is it being high tax. It's not high tax because it's subject to 0% withholding, and it's not a CFC. I don't own the UK bank. I don't control it. Right? Separate entity. Okay, so that's why it's in the first basket, the passive basket.
So then moving on to the second source of income, which is the Canadian sales office. So we would have to assume that it is a branch, it is a qualified business unit. So that means that the sales office is separate and clearly identified unit of trade or business that maintains separate books and records. And then if it does fall under that qualification, it would be the foreign branch basket. And then the third source is the interest from the African bank, which incurs a withholding at a 25% rate. So because it's at a 25% rate, it falls under the exception to the passive rule because it's above the 21% US rate. And then it's also not a foreign branch limitation, so then it would fall under the general basket.
So we have the passive basket, we have the branch basket, and then we got the general basket. So I would do 3 FTC limitations in silos on these things. And what I suspect we're going to have is the passive basket would be excess limit, because the income is not subject to foreign tax. I'm going to have a big limitation around how many credits to utilize there. The Canadian branch, the Canadian has a 2 tax rate system. They have a federal tax and then a provincial tax. And the provincial tax differs by what province you're in. But usually you think of Canada being in the upper 20s, the combination of those two. So that's above 21. So likely I would guess it to be excess credit in my branch. Sorry for my handwriting. Excess credit in my branch basket. And then my general basket over here, because the interest is subject to high tax withholding, got kicked out of the passive basket. Falling to general is also going to be excess credit. So what the U.S. is doing in this basketing is I'm effectively protecting my ability to fully subject the interest from the UK bank to 21% tax, because it's not offset by the excess credits in the 2 other baskets. That's how all the pieces fit together. If I didn't have baskets, then this would all get averaged across, and I wouldn't collect full 21% on that UK. Okay, perfect, thank you. All right. Okay, so effectively, this is what we're going to be doing. We're just tweaking and building on what we talked about before. But if you like my shorthand way of doing this, the FTC limitation is by basket. The net foreign source income is by basket. And then it's times 21% rate for a corporation. I'm doing the same FTC limitation, I'm just doing it up to 4 times. Prior example, I had 3 of the baskets represented. That's all you're doing. Okay. If you like the first example, then you just got to do your separate limitation is your numerator over your worldwide income, and then you get your basket limitation for each one. Okay. So you can think of, what if I'm doing things in one country, but I have different income streams in one country? Remember that example? I have different baskets represented by that one country. Remember that one look-through example that we had that I, make sure you did this. This 100,000 was split between 80% and 20% between 2 baskets. Then what happens if Forco assesses tax on all of the baskets in one tax return? I have to allocate the credible foreign taxes amongst the different baskets, right? So I have to take my total foreign tax and put it in the different baskets because I got multiple baskets represented in that country. So if the foreign tax return, which most of them are, will put all the income in one tax return, then it's a pretty simple allocation method. I have to take the income included, income subject to foreign tax included in that basket is my numerator, all over my total income, and then I multiply that times my foreign income taxes paid. That's going to give me I'm going to spread it amongst the baskets. So in that country, if 80% was one type of income, 20% was another, then 80% of the taxes go with 80% of the income, and 20% of the taxes go with 20% of the income. Right? That's the way you would deal with a foreign tax return that blends all the income and taxes in at one Why? Because I gotta do this calculation. So I need to have the foreign tax by basket. Do everything by basket. Okay, this example 418 is Sydney.
So in this example, USACO has $300,000 of creditable foreign income taxes paid on $1 million of foreign source taxable income. And that total foreign source income is split between two FTC categories or baskets, which includes $800,000 of foreign branch limitation basket income and then $200,000 of passive limitation basket income. And for purposes of applying the separate income limitations, the foreign taxes have to be allocated between baskets in proportion to the foreign source income in each basket. So when allocating the $300,000 of creditable foreign taxes to the foreign branch limitation basket, we do $800,000 over $1 million and multiply that by $300,000 to get $240,000. And then using that similar logic to the passive limitation basket, we allocate $60,000.
Yep, so that's just getting my taxes and then I test it compared to my limitation when I compute the limitation for both those factors. Perfect. Okay. Now you're all warmed up on baskets. Now it gets super complicated. We're going to the deep end of the subject. Okay. We have things called separate limitation losses. So I got four possible FTC limitations. It is possible that one of those limitations is actually negative. What if my branch operations had a loss? That happens, right? Not every business operation makes money. Doesn't make money every year. Pandemic, what happened? A lot of companies had losses. So if I look at those four baskets and one of them had a loss, then I'm into what is called separate limitation losses. Now this again is in the deep end of tax, it's in the deep end of international tax. What I do when I have one basket that has a loss, I spread that to the baskets that have income. Okay? So I first offset an SLL, separate limitation loss, called SLLs, in one basket against foreign source income in the other basket before it can offset any remaining SLL against U.S. source income. So I look at my baskets, to the extent one of them has a loss, I start taking that loss and spreading it amongst the positive baskets. Okay. If I do that and there's still positive income left in those baskets, I'm done. But you can imagine what that does for my baskets where I put a loss in a basket that was otherwise positive. That's going to lower my limitation, right? My multiplication, my net foreign source income in that basket is lower if I start putting a loss into that basket. That result is going to frustrate my ability to claim a credit in that basket. Okay? So, and I do this, I track this on a yearly basis. So if I take a loss from one basket and I share it amongst the positive baskets, in the future, when income is made in the basket that originally created the loss, I have to restore the income in the baskets that I previously offset. That's recapturing the SLL. Okay? So you can see, doing this over a period of time, I could create some excess credits that might be restored in the future when I gave the income back, if it's within the period I get to carry forward the excess credit. I only got 10 years to do this, back 1 to forward 10. Okay? But this is the concept of the SLL. Let me show an example of this. Some brave soul do 419. Genevieve, you did 419. But this is the best way to kind of understand this stuff. You just got to see how the numbers kind of work. Okay, walk us through this.
Okay, so in year one, USACO has worldwide income of $150,000, including a foreign branch limitation loss of $50,000, so $100,000 of passive limitation income and $100,000 of U.S. source income.
And so that branch limitation loss just means I could have lost money in a branch operation, right? If it's sales, maybe it's startup, and I just entered that country and I got more expenses from sales activity than I got income yet, so it's a loss.
So the numerator of the passive income limitation is only $50,000, that's $100,000 minus $50,000, that's the allocation of the separate limitation loss.
So let's go down here to the table. So this income, the foreign branch, this is the 50,000, and I had 100,000 of passive income. So I send the 50,000 against the 100,000, knocking that basket's income down to 50, right?
Yep.
And 0 in the branch basket. That's year 1, right? Okay.
So then in year 2, USACO has worldwide income of $225,000, including $25,000 of foreign branch limitation income, $100,000 of passive limitation income, and $100,000 of US source income. So because the USACO reduces passive limitation income by $50,000, foreign branch limitation loss in year 1 and year 2, USACO must recharacterize $50,000 of its foreign branch limitation income as passive limitation.
So then my passive income created by the passive activities in year 2 started at 100, but I get an extra 50 that comes over from the foreign branch basket because it turned positive by 75. So I take 50 of that and I restore the previously offset passive basket to get it back to 150. So you can see where the carry forward of excess credits can help me here because this fixed itself in 2 years. I may be okay with that. I might have a cash flow issue, but I may not have a financial statement issue. It solved itself within the basketing period. But this would affect the FTC limitation in year 1 for both of these baskets and year 2 for both of these baskets. Okay?
So after the recapture of SSL, the numerator of the passive income limitation is 50, 100,000 plus 50,000 recapture of the SSL, and the numerator of foreign branch.
So I'm just sharing between baskets when one happens to be a loss. Okay? So what happens if I do that sharing and there's still a loss? So my one basket loss is greater than the sum of my positive basket incomes. What happens at that point? Then we have what is called the overall foreign loss. Deep into the swimming pool here. This is called an OFL. We used to joke, many U.S. multinationals that found themselves in this position called it awful instead of an OFL. It was awful. It just really hurts your ability to find foreign tax credit. So, assume I had those baskets, but in this example, I had sufficient room in the passive basket to fully absorb the loss from the foreign branch of 50. If the branch was higher than the 100 of passive income, then I would have an overall foreign loss. What that means is it offsets and reduces U.S. source income. Okay? Meaning that when I'm doing that calculation, I have more losses foreign in my foreign operations than I have income. The U.S. taxes on a worldwide basis. What does that mean? I am going to utilize that overall foreign loss to reduce my U.S. taxable income. Right? Worldwide taxation sounds like a problem when there's taxation, but there's also relief if you have a loss, because you're going to reduce your U.S. tax liability. Okay? So if I had, I'll take a simple factor, U.S. parent has a foreign branch, we're in the pandemic and the branch has a loss. That loss is going to offset U.S. taxable income. It's on the tax return. That's a good thing. The U.S. is subsidizing that loss activity. This rule says if that happens, don't come back to me in future years when that operation turns and becomes profitable and you want to claim a foreign tax credit. I am not going to give you the current year benefit of allowing my U.S. taxable income to be reduced by your foreign loss. And then you come back in subsequent years when you make money on the foreign side and say, you don't want to pay U.S. tax because you want to claim a full foreign tax credit. The OFL rules frustrate that future foreign tax credit. Okay? So, and this could be a large foreign branch loss. It could be a large amount of expenses, U.S. interest expense against foreign source income. whatever would cause a loss in that basket, it overwhelms all the income in the other baskets and offsets U.S. taxable income. That provides a current U.S. tax benefit, like I just said, and to mitigate the second benefit of in the future, when that foreign operation turns profitable, future foreign source income is recaptured as U.S. source income. So think about what's happening in the foreign tax credit limitation calculation. What was income in the future year got it pulled out of that calculation and was treated as U.S. source income, lowering my ability to claim the credit. When I was joking that my clients used to say this was awful, they only felt that second part. Oh my God, I can't claim a foreign tax credit because I'm losing some of my foreign source income. It gets re-sourced to U.S. sources. I always had to tell them, well, you did get the current year deduction. When you had the loss, it offset U.S. taxable income. This is just the U.S. trying to protect themselves because they tax on a worldwide basis. We can't allow you to offset U.S. taxable income with losses, pay less U.S. tax, and then when it becomes profitable, you get a full foreign tax credit. You have to give back the first one, okay, or mitigate the second one because you got the first one. Does that make sense? This is all a function of the U.S. trying to tax worldwide income. The rest of the world, most of the rest of the world where they do not tax foreign source income, the loss would not be deductible because they're not taxing the income. We got into this soup because we want to tax the worldwide results. You get all of these fact patterns that have to be dealt with, and if you have a loss, which does happen, if it's big enough, then you could find yourself in these overall foreign loss provisions. Okay, let's do 420. And that was Eli. So I think this makes sense when you understand what these examples do. So many times when you read the rule, it just becomes confusing, but just try to apply it in the example.
So USACO has operations in both the U.S. and in country F. In the first year, the foreign country F branch incurs an OFL of $100,000. In the U.S., USACO's operations earn U.S. source income of $100,000, on which USCO would otherwise pay $21,000 in U.S. tax.
So let me pause you there. So the $100,000 of OFL, so the branch lost $100,000 and the U.S. only had $100,000 of U.S. activities. When I do my tax return, I get zero taxable income. The U.S. says, well, I would have collected 21 on that U.S. income, 21%. But I couldn't because the foreign loss offset that. That's the problem. That's the first benefit. People lose sight of that and they only see the pain in the future. But the U.S. said, I gave you that, which was a good guy, subsidized that loss by not collecting U.S. tax. Now, in the future years, what happens?
In year 2, USACO again has the $100,000 of U.S. source income, but the foreign branch rebounds and earns foreign source income of $100,000, paying $25,000 of foreign taxes. So the worldwide income is $200,000. So in the second year, the USACO must recapture its U.S. source income, $50,000, which is the lesser of 50% of foreign source income in year 2, with previously unrecaptured OFL of $100,000. So the USACO computes its foreign tax credit limitation.
So let me pause you there. So that 50% test, the U.S. says, I see in the past where $100,000 of foreign loss offset U.S. taxable income. That's your OFL balance, overall foreign loss balance. They don't make you recapture 100% of that. You have to recapture maximum 50% of that or your future foreign source income, whichever is less. So you don't, they do make you give this back, but it is over time. It's not immediately dollar for dollar. So you max 50%. Okay, take us through that.
And then the pre-credit U.S. tax on the worldwide income, so that's 21% times 200,000. Foreign source income divided by the worldwide income, so that's 50,000 divided by 200,000.
And I made 100, but I only got to keep 50,000 in my numerator because I had to recapture that because I had that prior loss offset, right? And you can do this over here. I could have had, I had 100,000, but I had to recapture half of that, so 50,000 times 21 gets you to the same 10,500. So what have I had here? I paid 25,000 of foreign tax, I wrote over it, but I only got the credit 10,500 of that. That's the awful scenario if you were the person in charge of taxes that year. But what they didn't see is that before you didn't pay any tax because year one, you offset all your U.S. taxable income with a foreign loss. That's the concept of an OFL. Okay? I want you to kind of understand this. I don't want you to be an expert in OFLs, but if you get into an international organization, you might hear somebody talking about, well, this OFL I got to deal with. And this attribute can carry forward. This unrecaptured OFL carries forward unlimited. So if you've been losing money, you're going to have to give this back on your foreign tax credit. This will frustrate the CFO when they have to prepare for analyst calls, because trying to explain this to a stock analyst on 20 seconds on the response on the analyst call is not easy to do. You're going to have a script laid out for them. Just read this. Okay? And I put over here in the key takeaway, the OFL recapture causes a reduction in one's FTC. Okay. You could imagine the same thing could happen. What happens if I make money internationally and I lose money in the United States? Think about my foreign tax credit calculation. I did pay foreign taxes because I made money in the foreign operation, but the U.S. happened to lose money. There was a recession in the United States and it didn't extend to parts of the world or wherever else I was doing business, or something happened in my U.S. marketplace, maybe a competitor or something. It runs into my business, but I had a loss in the U.S. and I had income internationally. Then I could have an overall domestic loss. It's the same concept. I can't fully utilize the credit because I didn't have U.S. taxable income. I had a loss in the United States. So what this is a mirror image of what we just talked about. In the future, so year one, I have an inability to utilize the credit because I don't have a tax liability in the United States. Credit's only good if I have a tax liability to reduce it, right? So then what happens in year two when the U.S. makes money? Then I recapture that U.S. source income as foreign source income for purposes of my FTC calculation. So just like that one example where I could be whole in 2 years, I could be whole in a domestic loss foreign income situation by restoring the foreign source income that was offset in year one in year two. Okay, so this is just giving the U.S. Company a good guy because we took the bad guy on the OFL provision. This is an ODL, overall domestic. So you have to deal with these situations again because parts of a business don't move linear in one fashion, right? Not everything makes money every year. So this is the ODL, and it's a good guy for taxpayers. Okay, we'll pick up with this on Wednesday, and then we are going to dive into Chapter 5, which is our last big outbound topic, which is anti-deferral. It's going to be that book we're reading. We're going to really dive in. Okay, thank you. Everybody get the sign-in sheet? The real sign-in sheet? Why I think.
Yeah, just when I was like, I don't think they're right, but I'm not gonna interrupt them.
It used to be all nice and clean.
Oh, you must have forgotten that.
Which one?
The midterm and the final of this class was like back to back.
No. So the final year is on Monday. Yeah, because that's the finals are.
Is that what?
So I moved the midterm